and Happy New Year to all of you again. I'm Yvonne Schwab, ACG Silicon Valley CEO. Thank you for joining us today for our annual C-Circle Economic Outlook, ACGSV's first event in 2022. I'm excited to see you all. If you're new to ACGSV, we are the leading business-to-business networking organization in Silicon Valley, providing connections, thought leadership, and enabling personal and organizational growth. ACG Silicon Valley offers an array of networking opportunities. With over 13,000 members in 59 chapters across the world, ACG is able to provide local connections with a global reach. And sadly, we are still not back to in-person events due to the recent spike in COVID cases. However, until we can go back to face-to-face, hopefully in late February, ACG Silicon Valley is offering a variety of virtual events. Next week, we will have our first ACG California chapter e-lunch this year, a great opportunity to network with ACG members from all across California. On February 16th, and I'm super excited about this, we are tackling the hot topic of Web 3.0, an event you do not want to miss. We invite you to visit our website at acgsv.org to see the full calendar of what we have in store for you. Now, we're excited to offer you today's event, which would not have been possible without our sponsor, Singer Lueck, a top 100 accounting and consulting firm in the West region. Serving clients since 1959, Singer Lueck is providing the services of a large firm with a blended environment of practices, services, and industry specializations. Thank you very much, and we really appreciate your partnership. I would now like to introduce you to our moderator today, Andy Armstrong. He is an audit partner at Singer Lueck. Andy has over 15 years of experience working with companies in computer software and SaaS, professional services, manufacturing and distribution, clean technology, and life sciences. Andy specializes in working closely with venture and private equity-backed private companies in these sectors throughout their entire life cycle, from initial audits to their ultimate exit. Now, without further ado, I will hand over the mic to Andy so he can get us started on the economic outlook. Andy?
Awesome. Hey, thank you very much. I appreciate it, Yvonne. I'm looking forward to this discussion as well, and really appreciate Bob, Sean, and Chris joining us. And one real quick, one thing I will say is, please, for those of you who have joined the C-Circle in the past, pre-COVID, I'll call it, we love that more of a roundtable type discussion. So as you guys listen to this discussion and you have questions or comments, please feel free to either use the chat, raise your hand. We'll be monitoring that, but I'd love to get some comments going. I mean, we want it as interactive as possible. So having said that, again, what I want to do is just kick off by having the panel introduce themselves. We've got a great panel, and I'm just going to start off by Bob. You just want to introduce yourself real quick?
Sure. Thank you, Andy. My name is Bob Griffin. I'm with BNY Mellon Wealth Management based in Menlo Park. I've been in the industry for 30 plus years, and prior to joining BNY Mellon, I was the regional chief investment officer for Comerica Bank. And I have a long history on Wall Street as well.
Thanks, Bob. How about
You're welcome.
Sean? Do you want to introduce yourself real quick?
Sure. Good morning, everybody. I'm Sean Randolph. I'm Senior Director at the Bay Area Council Economic Institute, and we are basically a think tank on the economy of the San Francisco Bay Area, Silicon Valley, and California. We are a part of the Bay Area Council, which is the major regional business organization, about 350 companies across many industries. And essentially, we look at economic and technology trends and related policy issues in the region and in the state.
Awesome. Thank you, Sean. And Chris, how about you?
Good morning, everybody. Thanks for having me again. I started my career in 1985 U.S. Bank, and then in 1994, I founded Silicon Valley Capital Partners. I'm the current macro economics and capital market strategist, and we serve clients here in the Bay Area and all over the world, actually. Thanks for having me.
Awesome. Thank you so much, Chris. All right, now to set the stage, I'm going to open up and ask everybody a question, but just, considering where we're at right now, right? This pandemic that never wants to go away. It seems like we've talked about this now our third year in these meetings, but considering also the fact that in October and November in 2021, 8.7 million Americans quit their jobs just voluntarily. Oil and gas production is down 2 million barrels a day. 12-month annual inflation rates over 6%. Real unemployment's at almost 8%. U.S. household debt is 15.6 trillion. The U.S. government is 30 trillion in debt. So, this is kind of where we're at right now. And I just want to open it up to the panel to start. And just what is your current view on the state of the U.S. and economy, as well as the Silicon Valley economy? And Bob, I'll start with you.
Sure. That's pretty heady numbers there, Andy. But overall, we're very constructive on the U.S. economy. The economy is actually strong, given all those kind of, I would say, challenging hurdles that you face in terms of employment and costs and such. But the economy is actually expanding, and we do foresee that continuing in 2022 into 2023. Within Silicon Valley, it certainly has been the leader of this kind of recovery and really didn't have the same effect or hit that COVID has presented to other industries. So it's been doing exceptionally well.
Awesome. How about Chris? Do you have anything to? Oh, yeah.
No, I was just going to pass it on to the next speaker.
Perfect. Chris, how about you?
Question about how the economy is doing is a very big question. I think that there's micro problems here in the US, different areas, but at the macro level, consumer spending is hitting an all-time high. Our net imports are breaking records, and S&P 500 profits are hitting all-time records and will go higher in 2022 and 23. So just think about it at the macro level, the economy is looking really good.
Awesome. And Sean, how about your perspective on the Bay Area?
Yeah, I would agree with both Bob and Chris. It's not to say there aren't issues out there, but actually household savings have been going up nationally, helped to some degree by the federal financial support for households. There was a lot of pent-up consumer demand during the pandemic that's being released now. And so I think demand is high. Services hasn't been as strong as goods, and so we're seeing, of course, supply chain issues, but to some degree, it's a reflection of a very strong demand. And here in the Bay Area, the tech economy is probably stronger than it ever has been. And that's really the leading edge for our economy here. So, overall, despite all the issues out there, I think the outlook for this year is pretty good.
Awesome. Thank you so much. And I want to go back to Chris real quick in terms of just your outlook. You had mentioned that you think the S&P is going to just continue to go strong, but could you talk a little bit more about exactly what you think the S&P is going to do in 2022?
Yes. So let me just start by talking about, we came through 2020. We shut the economy down. Most of us have never experienced this in our lifetimes. And then we rapidly turned the economy back on. So these two events could be problematic. And the biggest single thing that's happening today that should have been expected, but maybe worse than we thought, is inflation. Inflation is coming in very hot. But think about, what would cause that. I'm making an attempt to share my screen. So give me 1 second here. I'll just bring this up. I'm going to put up, let me know if you can see this slide.
Yes.
Okay, so this is just a table from Bloomberg Intelligence. It's a summary of the Bloomberg economic consensus outlook, what happened versus where we're going. So, what happened was we turned the economy down, turned it back on. In 2020, imports dropped, and then they had a very rapid acceleration. So it's very obvious to me that we should be having supply chain problems of goods coming through the ports. And of course, we have a labor problem. And so this all translates to a supply chain or supply side inflation. And mathematically, we should have expected this. I see it as a normal thing to happen. And I also think that if you look at this as an event-driven economy, we are going to have moderation in forward GDP numbers. We're going to moderate back to the average of 2014 to 18. Imports will moderate. And as these things happen, inflation should also moderate. So I'm looking at this economy as an event-driven outcome to normalization. Okay. Now, if you take that framing and look at what actually happened in the third quarter of this year, the reality is, in one of the highest full quarter reports, the third quarter, S&P 500 revenue grew to 18.6% year over year. Margins expanded 3.3%, and earnings, of course, jumped 54%, coming off of a lower base, right? But the takeaway here was that the US S&P 500 companies were able to navigate inflation and pass on costs to the end customer. And I have this expectation for the fourth quarter and actually for the full year 2022. So why is the stock market selling off sometimes? Why is the market so volatile? Okay, I think this is feeding into your question, right? And what I think will happen. So I'll just bring another graph up and talk about what's happening and just remind everybody we've been here before. So 2013 was the point where the Federal Reserve, Ben Bernanke, started talking about the Fed's intention of normalizing monetary policy and normalizing the Fed's balance sheet, referred to as the 2013 taper tantrum. But in reality, what happened, if you go back, is the revenue forecast of the S&P didn't change very much. Margins in 13-14 did not change much, and the earnings outlook did not change much, but the market was pretty crazy during the taper tantrum, two very significant sell-offs. And so we attribute this to the changing yield curve. So think about, in this graph up here, I'm just going to point at it. It's a very simple thing, actually. You take the Treasury maturities from 30 days all the way to 30 years and just simply graph the yield off of these maturity differences. And that's the Treasury curve. Very simple thing. And you can see where we were in 2019. I'm comparing it to what normalization looks like and comparing it to 2018. So we see that the yield curve at the 10-year has risen, and it will probably continue to rise to 2, could go as high as, above 2.5. The consensus view is that it stabilizes out in the back end of 23 at around 2.2%. But here's the problem. When the rate of change of the 10-year yield rises faster than 30 basis points in a 1-month time frame or less, the rate of change happens quickly. That does trigger significant computer selling. They're really not even humans doing it. They're algorithmic, quantitative rebalancing. And this happens every time. The Fed comes out and makes an announcement. Bloomberg or other economists revise what they heard. We hear the Fed's going to get more aggressive, more hawkish. People start rebalancing their bond portfolios. The yield curve steepens very dramatically, causes a sell-off. Just so you know, within the next 6 months, 2013, this happened. Within 6 months, the yield curve stabilized, market stabilized, and continued their ascent. So I expect this year for the Fed to come in pretty strong. They're going to do what they have to do to keep the capital markets confidence levels high, but they're also going to try to navigate monetary policy without disrupting the bond market. So it's a tightrope. And so the consensus view is 3 rate increases this year. Goldman came out on Monday saying they think 4. The challenge here is that it looks to us, and the consensus view is that there's a very big slowdown coming in 2023. So the Federal Reserve has to walk a tightrope of dealing with inflation this year without over tightening and putting us into a recession in 23. So it's going to be interesting, but expect a lot of volatility based on the yield curve ascent, but not an change in earnings outlook. Okay.
Awesome.
I think we'll break 52 or 5,200 or higher on the S&P by year end, but we could be even flat or negative in the first 2 quarters as the yield curve repositions.
Thanks, Chris. It was great. And you had mentioned something, and I want to ask this question to Bob that came in from Jim. Is just in terms of the skyrocketing energy, food prices, and real estate prices are not a result of shutting down the economy, as those sectors were not shut down. But what factors will cause these to moderate, do you think, Bob?
Well, interest rates will have an effect on housing because the cost of borrowing goes up. And so we've kind of, as interest rates go up, refinancing will slow down dramatically. And then the cost of borrowing for new purchases will increase. So it will have a way of separating people who have various wherewithal in terms of the marketplace. Where energy is affected is there's a confluence of several factors within that. And that is, you stated earlier, the reduction of 2 million barrels of oil supply on the marketplace. And that was driven by the present administration, because prior we were energy surplus and we're exporting energy or oil, and today we're not. And the other exporters do not want to see prices go down because they need to support their own economy's balance sheets. So we do foresee that energy will continue in its present form unless we start to see a change in our current administration's policy on oil production. And so that will kind of go through, and that's part of food and energy are being the biggest components of the inflationary cycle. We've seen this shortfall. But certainly, as Chris said earlier, the supply chain situation will change, and those inflation pressures will abate as they normalize with present demand. And we do see that inflation will come down in the next couple of years. And that tightrope that Chris mentioned with the Federal Reserve, it's going to be a tricky one because they have a tendency to overshoot, and inflation numbers are lagging indicators, not leading indicators.
Yeah.
And thank you so much. And to follow up on that, Jim's additional question is, as the Fed was incorrect on the transitory nature of inflation, do you have confidence that it can walk that tightrope that you guys are talking about of raising interest rates without driving the economy into a recession?
That's kind of a loaded question because each chairperson has their own different way of looking at it. Ben Bernanke had his way. Janet Yellen had hers. Right now, Chairman Powell is up for re-election, and we'll see what President Biden does in terms of his renomination and as the role. But at present, they certainly have been forecasting these rate increases, but they're also at the same time dealing with a very large balance sheet, and thus the tapering of how they're going to continue to do that. And you've seen that already discounted into the bond market and the reduction of their purchases. If they get too aggressive on the rate increases, as Chris talked, you can throw the economy into a stall, if we're using an airplane analogy, and that's going to be really tricky. But right now, the overall, some of the forces that are still disinflationary are still out there. Global aging demographics, Supply abundance, if we can get it through the ports, there's a tremendous amount of that. Pre-pandemic, companies didn't have pricing power. So some of those big longer term forces still are in place. We just got kind of stopped with this pandemic and everything got jumbled up. Is that kind of, and but as we stretch this pandemic to an endemic and people get back to normalization, whatever that looks like, inflation should moderate, and we can foresee that to continue, and that should be help well for the economy. And that gives the Fed a little more runway with respect to their monetary policy, particularly at the Fed funds rate.
Perfect.
And then, Andy, could I add that the thing that's different this time is Jerome Powell is the first Fed chairman in history to not be an economist. He's the first Fed chairman in history that did not come up for the Federal Reserve. And he's a capital markets person. That's what his expertise is. So I see that as a very big shift in how the Fed's going to deal with things. And the second thing is that the Federal Reserve, Jerome Powell has to look at, will raising rates really alleviate the inflation pressure that we have today, right? Supply side, supply chain and import and labor shortage inflation cannot easily be solved by raising rates aggressively, right? So I think they'll consider that and then think about this forecasted slowdown. I think they'll do a good job.
Awesome, thank you. And Sean, I wanted to ask you a question. We're talking a lot about the S&P, obviously, but what is your outlook in the IPO market for 2022?
I think that is going to be a bright spot for us here, certainly in Silicon Valley and the Bay Area. Of course, what's going on in tech, it disproportionately affects us here because so much of the activity is centered here. And 2021 was an incredibly big year. So we're seeing private equity getting more involved in tech. So private equity investment in tech reached 1.2 trillion last year. That's 64% more than it was the year before. There were like 850 billion in private equity exits last year. And behind that, venture investment blew away records again. So through the third quarter, the data we have, 96 billion was raised compared to 88 billion in 2020. So this year, or 2021, we're going to easily pass $100 billion in funds raised for the first time. And we're seeing now bigger funds, faster growth in the funds, and also more exits. So I think looking to the future, right now, venture firms are sitting on about $220 billion in so-called dry powder, funds available for investment that haven't been committed yet. Looking at just the funds that they raised, just last year, almost $240 billion raised by venture funds, compared to 168 billion in 2020. So you can see this enormous surge both in fundraising and investment in the last year. And that's been going into both early stage as well as later stage investment. So look on the IPO channel, first we're seeing like a record number of unicorns. About 45% of all the unicorns, companies valued at $1 billion or more in the US are local companies here in the Bay Area and Silicon Valley. There were about 140 of those in 2021 compared to 100 or so the year before. Compared to that, New York had less than 70. So you can see this huge concentration of unicorns here, and that also applies to the so-called decacorns, the 10 billion or more valuation. So there's this enormous flow of unicorns that is being replicated even as we speak this year, and that's reflected in a similar concentration of IPOs of tech companies here in the Bay Area, more or less 45%. last year. So like just last week alone, 7 local companies raised more than $100 million each. So I think the outlook for the year, whether or not we make another record this year, who knows, but there is a lot of capital out there to be invested, just waiting. The private equity and the venture firms, they're putting the money out there. They're raising funds, continuing to raise funds at record levels. So to the extent that we can say that tech is powering the Bay Area economy as it has for many years, I think that's really going to be a driving force for us.
And, one question I have to follow up on this, just incredible amounts of capital that just keep coming from everywhere, is the SPAC. How do you kind of attribute this whole SPAC environment, and I call it the SPAC craziness in my world, but because we've seen so many SPAC transactions that, is that adding to the fuel to the fire? Do you think the SPAC world is going to just keep flowing? Is that slowing down at all?
I think it's been a factor, but I wouldn't attribute, this enormous growth to SPACs. And I think most likely, we'll see some cooling off this year in the SPAC trend.
Perfect. What about, you'd mentioned a lot about the tech in Silicon Valley, but how is this whole remote work? I've seen everybody seems to be moving to remote work, and especially here. And how is that going to affect tech in the Bay Area in 2022?
Well, it's a huge question, not only for tech, but of course for everybody. It turns out that, if you look at the Bay Area versus other major metropolitan areas in the US, a much higher percentage of jobs here are what you would call susceptible to remote work. And in fact, the percentage of the workforce here that is working remotely is much higher than it is in most other cities across the country. A lot of that is attributable to our large service industry base and attributable to tech. As we all know, most of the tech companies have been working entirely, if not almost entirely remotely over the last 2 years. So, and we're seeing the dates. Some companies are saying we're going to be remote permanently. We're never coming back to the office. There aren't many of those, but a few are. A handful are saying we're going to be back, entirely. The great majority are saying, we're going to arrange some kind of a hybrid arrangement, and it's up to every company to figure out how best to do that. But many were saying they're going to start bringing people back to the office like last September. And then we saw the Delta surge, and then that was put off to maybe the end of the year. Oh no, well, holidays, let's make it January. And of course, with the Omicron thing now, you're seeing tech company after tech company, like others, delaying their return to the office again. So now, depending on the company you look at, they're saying, well, maybe March or maybe later than March. So, that's kind of a moving target. But the effect is that a very high percentage of the workforce is continuing to work remotely for longer periods than anybody thought. And that's becoming a permanent thing. So I think the impacts of that are going to be, obviously there's impacts for like downtown areas, like downtown San Francisco, downtown San Jose, downtown Los Angeles, or pick any city with a lot of tech, where, the downtowns are currently pretty depopulated. And the question is, to what extent and how quickly do people come back, because that affects those economies. But I think the bigger issue for tech really is a lot of the model around Silicon Valley for many years was around concentrating people together, cramming them together. You get the kind of the innovation effect and the interaction, and everybody pretty much came in. And now it's accepted that many, if not most people are going to only be in the office when they need to, and it'll vary by company. So that gives more options for where the workforce is located. And because we have these incredibly high costs in the Bay Area, we saw during the pandemic a lot of people moving out. Lots went to Texas, it's like Austin, to some degree Dallas or Houston. Some went to Boise, Idaho, or Bend, Oregon, or Phoenix, or Miami, or wherever they chose to go to. Yeah, even Nashville. So I think we're looking one way or the other at a much more distributed workforce than we had in the past. Most of those who left the center cities, left the Valley and San Francisco, didn't go very far. About 80% just went to other places in California, typically distant suburbs, the Central Valley, where they could still get in if they needed to, but they hadn't left the area itself. But I think net, we're looking at a much more distributed workforce, probably on a permanent basis. And I think that'll change how offices are designed. That'll change to some degree where companies choose to locate certain functions. We'll just have to see how that sorts itself out over time, but it's definitely a permanent phenomenon.
Well, and to follow up with that, Sean, how big of an issue? I think we all hear how this mass exodus from the Bay Area, from California, as you just mentioned, but so far, are you seeing any real issues or negatives that have come out of this with this, or how big of an issue do you really think this quote unquote exodus from California is?
It's an interesting question, and I think it is and isn't a big issue. I think the exodus, well, we could debate what the term exodus means and whether there actually is an exodus. We know for a fact, terminology aside, that there has been a net departure of companies. So typically companies will leave always, but more move in, or some move in to compensate, or people will leave, but more people come in. I think what we're seeing in the last year, which is likely to continue at least for some period this year, is that there has been a net loss of people. That's because people left, but fewer came in. And the big variable there is historically, we've had more people coming in from around the world globally. We have a lot of talent here that comes globally. But of course, the last 2 years, nobody was coming, or very few people were coming. You couldn't physically come, even if you wanted to, and there were a lot of reasons not to come. So we've kind of lost for now that compensating factor of the global people, the other people moving in to compensate those that were leaving. So
and Scott, can I interject one thing there?
Please do.
I do. Everything you're saying is what I'm reading too, by the way, but I was looking at a Bloomberg data set about California, and they pointed out that if you added back in foreigners and foreign students, California did not shrink. So that's a really important thing to realize.
Yeah, I think what's happening, I agree. We've had a historic pattern of net domestic outmigration, but not an exit. It's just leakage and some people leaving, but the foreign people have compensated for that, where we've actually had positive growth.
That'll turn around. We'll open back up, and that'll all recover. I
think that's true. We're actually doing a study right now looking at the international presence here, corporate innovation office and all that stuff. And what we're finding in a preliminary way is the great majority are still here, and many plan to actually expand this year. And then I think as campuses open up, which they will inevitably, that will affect things. And also on the H-1B area, the skilled immigration side, under the Biden administration, it's a much more open environment than it was under the Trump administration. And we're seeing the rate of denials of applications dropping dramatically. So under Trump, about 24% or so of applications were denied for H-1Bs. I think under Biden, it's down to like 4%. So I think you're right that we're going to see the international people coming back. They can't flood back because there's a lot of issues still, but probably by the end of the year, we'll see them coming back in. But I think to kind of just close on your question, Andy, about the exodus. So there are real reasons behind it. I think the remote work is probably the biggest one. And companies may be wanting to some degree follow where their employees want to live, where they can afford to buy a house, because we have the most expensive housing costs in the United States, along with New York City. That's part of it. I think some people would point to concerns about taxation, concerns about ease of doing business and business regulation. So that factors in as well. So I think it's a concern in the business community. It certainly is for the Bay Area Council, like what's behind that. If you look on the positive side, this record number of unicorns that is continuing to be generated, again, almost half of the ones in the United States, these are companies that are growth companies. And assuming, which we shouldn't take for granted, that for the foreseeable future, they continue to grow here, I think that will sort of generate a lot of new business activity, offsetting those that have chosen for a variety of reasons to leave. And by the way, those that leave don't always leave. So maybe Oracle shifted people out of town, but people are still occupying those buildings. Well, they're not occupying the buildings.
Really
the employees are still there. A lot of the activity is still here. Sometimes but not always, it's just a shift in the corporate headquarters for a variety of reasons.
Perfect, thank you. I want to go back to Bob. We hit on this a little bit, but I want to dive in a little more just in terms of this, the deficit, right? And all the money that has been put in by the government into our economy to try to keep us alive during this pandemic. My question is to you is, what is the impact of this just ever-growing deficit and all the stimulus money that you foresee in 2022 and the future?
Let's go back. Let's start with the stimulus money. We still have COVID-related fiscal policy that is still being folded into the economy that was approved in 2021 on these COVID recovery type acts. And we're still seeing those effects go through. And that was part of the challenge of the BBB plan that the present administration is, because one, we had a senator, a couple of individuals who were really concerned about the deficit. The interesting thing about the deficit is if we can get the economy to grow, we have the revenues to service that. The challenge could be is the rise in interest rates. It just makes those dollars, those tax dollars, it's more expensive to service. And inflation has also a negative effect on that as well. So what we really need is a Congress, remember they control the spending, is to really work on paying some of that down, because we were also dependent upon foreign buyers buying our debt. And that is a global phenomenon. And so at present, I'm not terribly worried about the deficit, because if our rates are higher, then it's more attractive for capital around the world to buy our debt. They want money will flow to where it's best utilized. But longer term, as Chris said, as there is a potential risk in a recession, then it becomes a more difficult situation for government to do any fiscal policy to stimulate the economy. So it can potentially hamstring the US. But at present, I'm not presently worried about it. I think we can handle it, but we just gotta not be cumulatively spending to say we're spending, just from a political standpoint.
Could I ask a question of Bob or Chris? I think you may have said, Chris, earlier that the inflation is being driven by these pandemic-related supply chain issues, but I've heard different views of whether the scale of spending proposed in Build Back Better on top of the federal pandemic stimulus funding that is continuing to be spent, whether or not that is a significant factor driving inflation. Would really be interested in what you think.
Bob, you can go, I'll go.
No, yeah, I don't foresee it's really driving inflation at this present point. I think it's really supply driven. The one lagging challenge with inflation could be just on wage price pressures. And as the demand for jobs and talented individuals, those costs may continue further on. But other areas, food and energy and other goods, we'll see that inflation abate down the road. So Chris, you want to add to that?
Sure. I'll just say, I appreciate that question, Sean, because it does pose or present a big challenge we have right now. Right now, we have Congress trying to put forward fiscal stimulus policies. And at the exact same time, we have the Federal Reserve preparing to tighten monetary policy. These are opposing policies. And I don't think they'll end well if they don't work together. Why are we stimulating on the physical side and tightening on the monetary side? I've never seen that in my entire life. So that's why you're seeing a lot of tension in Congress with conservative Democrats backing down from these policies. Do we really need them? I don't think we do. I think the economy has legs. Okay, so the issue of inflation is very complex right now. I talked to investors all over the U.S. Down in Arizona. There's a grocery chain operator down there. They're reporting that a head of lettuce now in Arizona is the price is up almost 200%. And the issue with that is they grow that lettuce in the area. So why is lettuce up 200%, right? So this is complex. There's a lot of things happening right now. The big ticket items of inflation really are supply side, but the economy is going through a very untraditional business cycle recovery. And I think in the end of the day, what's going for us is technology. Technology is a very deflationary force, right? That's what helped us from the 90s, the advent of Walmarts and all these superstores, the huge jumps of productivity, and then the Amazon effect. All of these things give consumers the ability to seek out the cheapest price. When the economy normalizes, monetary policy normalizes, the technology effect will come back and should help the supply demand problem and moderate inflation across the board at the micro level, at the macro level. That's kind of how I see it. We're just kind of going through some very challenging things right now.
And Sean, I agree with Chris, because that's the way I see it as well. The disinflationary forces are still present. They're just not today being discussed, but we do have an aging population. Europe, China, the one-child policy has been really hampering them. There are other issues around the world. China has a water shortage, for example, that's not being discussed. But these things, that the pricing power that the Amazon effect, as Chris eloquently put, is still there. You can go into Costco and then you can get on your phone and look what it's at Amazon, and it's the same item. You go where the price is the cheapest, and that's just more consumer behavior. And as these things and these ports go through, the goods will reappear, and then we'll see, a lot more for sale and discounts as the supplies pick up.
Let's hope for the best.
Yeah, absolutely. I agree. But I do feel, it's a logistic issue. And I think technology has had just a tremendous disinflationary effect on the globe. Just the way we even managed inventories just in time and all different matters of how things are distributed. It's really been a beneficial to the consumer.
Thanks, guys. You just hit on, a couple times, just in terms about the administration and, Congress with the what you had just mentioned, Chris. The question I have is, what is the impact of the new administration, the impact that they're having on consumer and business confidence right now? And how is that going to change in 2022?
Who's first?
Bob.
Okay. Okay, so yeah, consumer confidence, that's a good leading indicator. There's different economic numbers, GDP and inflation are lagging, for example. But consumer confidence and business confidence are good leading indicators, as well as housing starts. So the interesting thing, we have this divergence right now at present. We have business confidence high, and if you look at the charts, and you can get that from the government sites, but now we have consumer actually popped off the bottom as we opened up the economy. Now it has pulled back down. And the one would look at, okay, Omicron being an effect of that, the kind of the negative news that is presented by the media on a daily basis. But certainly the administration has a part in this, and what they're messaging to the people. And the people are just you and me and every other consumer, but businesses see a whole different framework of activity. And Sean talked about it, and so did Chris. So I do foresee that changing, but they also going to have to change their narrative. And the midterm elections are an important thing for the present administration. If they do lose the House or the Senate, then the current president becomes a lame duck, and then nothing fiscal will be ever presented. And but I do foresee that chart or that downward thing to turn up as the Omicron variant starts to dissipate and really come down precipitously. And as Sean said, kind of maybe the return to the office and the normalization, that will improve consumer confidence as well. So right now they're divergent, and that's kind of a challenging thing. So if I'm in the administration, I have to look at that and say, okay, how do I change the consumer's perception, and i.e. voters in the long run?
Perfect. And I don't know if either Sean or Chris had anything to add to that.
I just had just a couple of small things. I love politicians who are dialed into the issues. They're spot on, and they have a plan, and they actually execute well. I don't care about political parties. I like people who are very good at what they do. And so this administration is doing some good things, but some things are big time falling behind. The biggest bottleneck that I see among our clientele, what I read my own firm, is childcare. Here we are at the beginning of 2022, and if you have kids, young kids, you cannot find a solution for your childcare to get back to work. And that is a very large part of our workforce. I see that as a wage inflation bottleneck. Okay, wage inflation bottleneck that is simply not being addressed. And that will become a major cloud overhang for this current administration. Second thing, how could we possibly at this stage run out of testing kits? How is that possible? Right? A national shortage. It was reported over the holidays that over 1/3 of New York's essential service workers were calling in sick, and no way to test them. And it just happened to be on the Christmas and New Year's holiday. How many of those people were really sick? It's a inflationary or services bottleneck because we're not planning around the known issues, tackling what's going to stop our economy from moving forward. So I think that this will impact, the future, how people think, what's going on. But we have to get people in power who are good at what they do, and they understand what the bottlenecks are for the U.S. people. That's all I have to say about that.
Thank you. Well, and to your point, I think that could be attributing a lot. Like we've all heard of the great resignation that's gone on. As I mentioned at the beginning, in October and November alone, almost 9 million people voluntarily quit their jobs. Maybe we could spend a couple minutes talking about that. I mean, childcare is a huge thing. I know my wife quit her job because of the childcare issue that we have during the pandemic. But do any of you have any comments on that? What else is kind of impacting that resignation, and how long we think that's going to last?
Well, the childcare, I agree, is a huge issue. It was an issue before, but it's a much greater issue now, especially with people having gone home and schools not being completely reopened. So I think some of that will be affected by when and how schools fully reopen. But it's definitely an enormous issue. Another factor has been the fact that there's been a very high level of retirements. Now we have an aging population anyway, so I think it was foreseeable that you would have a growing number of retirements. On the other hand, I think that accelerated perhaps, people were at home and decided, well, I was going to retire next year or 2 or 3 years from now. I'll just do it now. It doesn't mean some of those folks won't come back in the workforce, either in their former capacity or some new capacity. So I think it's an open question, the degree to which people who retired actually come back. But I think it's a combination of factors such as lack of childcare, people looking for better wages. Of course, they've had many cases of federal support, so they've had the option to kind of consider their options. So I think we do have a long-term issue, however we look at it, with the workforce, because it is an aging workforce. I think the pandemic has affected some of that. We've had fewer people coming in from overseas. Maybe that'll turn around in the future.
Perfect. And we're almost out of time. What I wanted to do is just ask a couple quick questions. Kind of, yeah, they're going to be broad, but in terms of, like, for you, Chris, what do you think the biggest risks are that we're going to face in 2022?
Two things. The COVID-19 pandemic not presenting itself the way we're forecasting it to. Maybe worse, a new virus. That's an obvious one. But I think the biggest one is Federal Reserve policy. Remember, I'm biased. I'm a capital market strategist. So when you say risk, I hear the stock market going down big. Someone else hears risks, they hear losing their job, right? So I'm not talking about the real economy. I'm talking about, in my profession, what would cause the stock market to have an unexpected outcome. It is clearly Federal Reserve policy, clearly. Okay.
Yeah,
Perfect.
I would agree with Chris on the capital markets. The Federal Reserve is going to be the linchpin of this, and how their glide path in terms of moderating inflation. And then if the factors come where we start to see supply chain improvements, that could change their timing quite remarkably. The other things that I always concerned is the things that are always present is the geopolitical risks, right? How aggressive does China become? How aggressive does Putin do? They all have real structural problems in each of their countries. And so they are creating these events, and that puts the US at an interesting position. Does it defend its NATO partners or potential partners? Does it defend Taiwan? These things can have real big issues globally. There's always that third item out there that you never see. And I'm always trying to find what that is. But I don't foresee the kind of the big macro changes that we had, like in 2008 with the financial crisis. Balance sheets are stronger. They've done a lot of great work. Corporate governance has been stronger with respect to their balance sheets. So I'm very positive on that side. So I don't foresee any on the business end. But those three, geopolitical, Federal Reserve, and that one third variable that it's out there that we can't foresee, similar to like having the COVID, right? The pandemic came out.
Absolutely.
Can I add some things to what Bob is saying? Because I do get a lot of questions about, what about China? What about Taiwan? What about the tension going on there? So I think one way to look at this is think about it mathematically. The Chinese have a 260% debt to GDP. They are on the cusp of a real estate debt default wave. The Chinese economy is slowing down faster than they forecasted it to. And China is now very much dependent on the West for exports. So if you put all this together, does China really want to have a fight with their biggest customer? Think about yourself. You run a business and you have your biggest customer that's paying you so that you don't default on your home mortgage. Are you going to have a fight with your biggest customer? And I would hold that the answer is probably not. In China right now, they're in no position to have any kind of military conflict. So I think the war of words continues and all the tensions happen, but I wouldn't be looking for a big military conflict with the West.
I'd probably add in on that I I agree with what Chris is saying, but with maybe a wrinkle that, there are these huge issues in the real estate market in China, but because about 30% of the economy there is linked to real estate, I think the government there will do absolutely everything they can to prevent Evergrande's issues spreading more broadly in the economy. And that's a big political issue for them. I think that if we look at the global risk, there's a risk out there in a lot of ways, but I think the one thing that just comes up again and again is China, and that could be an economic risk, but it could be economic stemming from political. And I think they're the one flashpoint with really the potential to go off the rails is Taiwan. And the only point where I would maybe take a slightly different view from Chris is that this is such a matter of political priority for Xi Jinping and the government there, that there's a certain level, I won't say irrationality, but a level of kind of political principle within that leadership group of reclaiming Taiwan for the mainland, that an accident, overplaying of a hand, could force their hand, even though I think they realize that it would be immensely costly economically and otherwise if there was a conflict. I think the other risk element, though, overall comes back to Omicron. I guess the question there, in my mind, is like risk for who? The degree to which people come back in the office, the speed with which that happens, that raises risk issues, which are foreseeable, of course, in the commercial real estate market. There are risk issues for business and smaller businesses that, especially in urban areas, that depend on people being in offices. So I think that the rate at which people come back to their offices in the wake of Omicron, I think is going to be a significant risk factor for parts of the economy. And this would actually include tourism. As I mentioned earlier, I think one of the reasons our job recovery in California hasn't been as strong as it has in other parts of the country is that we have so many jobs related to tourism and hospitality. And they've really taken it on the chin. We're probably down 300,000 jobs here just in that sector. And I think, so if you're in the hospitality and tourism industry, I think, you're still dealing with a pretty high level of risk until things stabilize.
Perfect.
Yeah, great.
Well, I was going to end with one last question, but I think we're out of time. I just wanted to know, when we're talking about risks, what are you most kind of looking forward to or excited about? I don't know if anybody just has one quick final thought on that before we sign off.
I'm looking forward to biotech. Biotech is flying, and there's no reason to think it's not going to continue to fly. It's happening nationally. A lot of that's here in the Bay Area. We've seen it in the IPOs. We've seen it in the huge demand for biotech space, which is to some degree offsetting the drop in demand for tech space. So I think it'll be important, I think, and a positive story to watch what's happening in biotech.
Awesome.
I'm looking forward to the continued and accelerating digitization of the U.S. economy and companies that are successfully deploying technology to grow productivity and grow their earnings per employee.
Awesome.
I think that I agree with both Sean and Chris on that. And what most excites me is the normalization, because once we get into that, we're going to see normalization of spending patterns and consumption. And that just bodes well for our economy. It's 70% consumer driven. And I'm also excited about technology and what it really has, because obviously if we're local here, we're all going to benefit from that. But from a global, it's huge improvement for mankind and productivity and all those improvements. That's really what I'm always excited about. And that's what I've always been excited about being in this region, is be a participant in that and see it. And I think what we learned in COVID, and to Sean's point with biotech, the rate that we can approve technologies and distribute them to the end user is tremendous. And I think we're going to see greater innovation with some of the diseases. And that's just going to improve our delivery in the healthcare area. And that's a big consumption part as we age as a population. And so I'm just excited about that. And I do think companies, there's jobs out there, they're good paying jobs, and that just helps our overall tax base. And I'm excited for the future.
Awesome. Well, hey, I know I went 1 minute over, but again, really want to thank Sean, Chris, and Bob. I really appreciate the comments, and this was excellent. So thank you so much, and thank you everybody who joined us.
Nice to meet you,
And,
Bob.
And thank you guys. Thank you, Sean.
Thanks, everyone.
Yeah,
Nice to meet
thanks everybody.
Sean.
Thank you, Yvonne. Appreciate it.
Thank you
Thank
so
you,
much.
Andy.
And one thing I quickly want to add is that I'm super excited to see where crypto is going. So, I hope you join us for our February 16th event, Web3. Thank you everyone for attending today. Thank you to the fantastic panel. Have a wonderful day.
Thank
Okay,
you.
thank you.
Thank you.
Very much. Nice to meet you guys. Have a great day.
Super.
Thank you
Thanks so
very much.
much.